This video offers insights and inspiration on a quick review of accounting basics to help you reduce future errors, an easy-to-follow path for reviewing your business financial statements and identifying common errors, demonstration of how to correctly make journal entries to avoid those common errors. Why check business financial statements for errors? Well, because accurate financial statements allow you to make informed decisions for your business. Suppose your balance sheet reports a negative amount in accounts receivable. Does this mean you owe money to your clients? How do you know how much to expect to collect from accounts receivable in the next 30 days if the amount reported is incorrect? What if a product line you offer is reporting a negative gross profit margin? Timely access to that information allows a prompt adjustment to pricing. An investment of time to regularly review your financial statements and correct errors will result in making better decisions for your business. It puts more control in your hands, and ultimately, that control allows you a better chance of building wealth in your business. Common accounting terms made simple. Accounting provides a framework for how, what, and when we record our transactions. Bookkeeping is an integral part of accounting that documents each financial transaction of the business. Cash basis. Now, cash basis accounting is an accounting system based on the actual flow of cash in and out of the business. Income is recorded when it's received, and expenses are reported when they're actually paid. This method provides an accurate picture of the cash position, but it's not clear on profitability because expenses are not matched to income. Accrual basis. Now, most small businesses use the accrual-based accounting method. It records income and expenses as they occur, regardless of whether or not cash has actually changed hands. This method matches the income earned against the expense generated, whether or not cash has been received or paid out, and always provides a clear picture of profitability. However, it does not provide an accurate picture of the timing of cash inflows and outflows. A cash flow projection is a helpful tool to predict future cash balances. Differences in accounting methods. It's easiest to see the differences in accounting bases with a transaction. An annual insurance bill of $1,200 is paid on January 31st of the current year. If cash basis accounting is used, the full amount is an expense on the date paid, and the current year would have $1,200 of expense. Under accrual-based accounting, the full amount is not an expense in the month of January. Rather, 1/12 of the bill is an expense of January and for each month thereafter until all 12 months have passed. The accrual-based method is matching the insurance expense to the period the expense is incurred. In the next month and so forth for the remainder of the year, the insurance expense would be recorded as a $100 debit to insurance expense and a credit to prepaid expense. Practice is the key to becoming comfortable and proficient in any discipline. Let's start by walking through a case study income statement and a balance sheet. We will highlight line items where errors are most common and show the steps to take to properly record the transaction. Income statement. An income statement reports income and expense activity for a specified period of time, such as a month, a quarter, or a year. It's where the profitability of the business is reported. Accuracy is important. Here's a tip. Review your income statement line by line to assess the accuracy. Does the amount of each line look reasonable? Are there negative numbers that should be positive? Zero fields that should have a dollar amount? There are 4 common errors on this case study income statement. Cost of goods sold is not recorded or recorded incorrectly. Depreciation expense not recorded. Negative expense line item that should be positive. Loan principal payments recorded as an expense. Let's review each error and the proper entry to use. For each correcting entry shown, the adjustment is referenced with the same journal entry number on the income statement and balance sheet. It's important to note that most journal entries affect both the income statement and the balance sheet. Cost of goods sold. Now, in our case study, the cost of goods sold for product B looks very minimal compared to the sales for product B. As the business owner, you have an immediate sense if that is correct or not. In this case, we know the cost of goods sold should be higher, and most likely journal entries were missed to record the reduction in inventory and the cost of the sale. Many businesses have integrated inventory management and point-of-sale systems that automatically record the cost of goods as inventory is sold. Here, cost of goods sold is reported as $3,500, but should be $145,000. A journal entry is made to debit cost of goods sold for $141,500 and credit inventory. Depreciation expense. In the case study, there is no depreciation expense recorded yet. Depreciation can be recorded each month. However, some businesses make one entry at the fiscal year end for the total depreciation expense allowed. The journal entry records the depreciation expense of $16,000 for the year to the income statement and to accumulated depreciation on the balance sheet. Negative amounts. If a line item has a negative balance when it should be positive, a journal entry may have been entered in reverse. In the case study, office supplies purchased on credit reports an amount spent of negative $1,375, which should be positive. The correcting entry amount is $1,375 times 2 to bring the negative to zero and account for the actual transaction. The following shows how to record the transaction correctly at the start. Loan principal payments recorded as an expense. When a business borrows money from a bank or other lender, the principal amount of the loan is recorded on the balance sheet, and the interest that accrues and is paid is reported on the income statement. The interest is the expense the business incurs to borrow money. Only the interest is reported on the income statement. In the case study, the full monthly loan payments totaling $12,871 for the year have been recorded as an expense of the business. The first step to correct is to reverse the original entry by debiting cash and crediting other expense interest. Next, record the $2,200 of interest paid by debiting other expense interest and crediting cash. The entry to record the principal portion of the monthly loan payment will be reviewed in the balance sheet section. Balance sheet. Okay, now let's look at the balance sheet for this business. There are 4 common errors on this case study balance sheet. The balance sheet does not balance. Accounts receivable is not accurate. Current portion of long-term debt not reported. Equity section not accurate. Let's review each error and the proper entries to use. The balance sheet must balance. The first step is to check to see if the total assets are equal to the total liabilities and net worth. Now remember, assets are purchased in order to generate sales for the business. Liabilities and net worth report how the assets were purchased, either with borrowed money or equity. In our case study, we see that total assets does not equal the total liabilities and net worth. The balance sheet does not balance, so we know there are entries that must be corrected. Let's begin at the top in the current asset section. Are there any unusual balances? Are there negative amounts? If the answer to either question is yes, there may be transaction entry errors that require correction. Cash. Does the amount look correct? Does it match the bank account balance? In this case study, the cash is not correct. The owner knows there is $5,665 in the checking account. He recalls investing an additional $5,000 in the business from his own pocket. To record this additional investment, 2 accounts on the balance sheet are affected: cash and additional paid-in capital. accounts receivable is reported as $34,650. Now, the owner knows that a sale was recently made on credit for $20,000 and is not reflected in the current accounts receivable amount. In reality, this error would also affect cost of goods sold and inventory, but we'll assume those entries have been made. To record the new accounts receivable of $20,000, a debit is made to accounts receivable with a credit to sales. Next, we'll review the fixed assets section for a common error. Accumulated depreciation is the total amount of depreciation for a fixed asset that has been charged to expense since that asset was acquired and made available for use. It correctly reports as a negative number on the balance sheet. In this example, the depreciation is correct because we already made the entry while reviewing the case study income statement. The entry used to record depreciation was a debit of $16,000 to the depreciation expense recorded on the income statement and a credit of $16,000 to accumulated depreciation on the balance sheet. Current portion of long-term debt. In this case study, the business has long-term debt of $22,113. A total of $10,671 of that loan will be due in the next 12 months as the owner makes monthly principal payments of $889.25. Payments due in the next 12 months are called current liabilities. The remaining balance of the loan is $11,442 and is not due in the next 12 months and therefore is considered a long-term liability. To record the current portion of long-term debt, debit long-term debt and credit current portion of long-term debt for $10,671. Recall with journal entry number 4, we made a correction to the income statement for principal loan payments incorrectly posted to interest expense. To correctly record last year's total principal payments to the balance sheet, debit long-term debt and credit cash for $10,671. This will reduce the balance of the long-term debt by the amount of the principal repaid. Moving forward, journal entries to record monthly loan payments of $1,072 are recorded each month with a debit to long-term debt for the principal portion of the payment and a debit to interest expense, followed by a credit to cash for the total payment. And finally, we review common errors in the net worth section of the balance sheet. Capital stock is the original amount invested to start the business. In the case study, the owner invested $20,000 to start the business. Additional cash injections made by one or more owners may be recorded in a separate line item called Additional Paid-in Capital. Entries for the owner's additional investment of $5,000 were already recorded in a previous example to correct the cash balance in the asset section. Retained earnings. This line item is important for building equity in a business. Reinvesting profits is how a business can grow. At the end of each fiscal year, the net income after tax from the income statement is recorded on the balance sheet in retained earnings. Owner distributions of the net income are subtracted from retained earnings or may be recorded on a separate line item titled Owner Distributions. Retained earnings are not necessarily reflected in cash on the balance sheet. Profits reinvested in the business in the form of retained earnings may be spent on equipment, debt repayment, or inventory, for example. If the business experiences a net loss at year-end, retained earnings are reduced by the amount of the loss. The formula for retained earnings is beginning retained earnings plus profits or losses minus dividends equals ending retained earnings. In the case study, the retained earnings should increase $10,373 from $79,371 in the prior year to $89,744 in the current year because the net income for the current year was kept in the business with no owner distributions or dividends. To record this transaction, debit net income and credit retained earnings for $10,373. Owner distribution example. In the case study, the owner did not take a distribution. However, let's look at the journal entries that would be made if the owner takes a $10,000 distribution of cash. A debit is made to retained earnings and a credit to cash for $10,000. Let's look at the corrected income statement and the balance sheet. Okay, so review your income statement and balance sheet on a regular basis for accuracy. Building this as a habit will allow you to respond more quickly to corrections that need to be made. The result is a set of accurate financial statements that are a valuable tool to use in managing your business.
We realize the success of your business directly impacts the success of your community and its people. So we push a little harder and we care a bit more because it's not profit for us, it's prosperity for all.